Hey, what's going on, guys? It's Steve. Hopefully, everyone's having a great week so far. Thought I'd jump on briefly with a reaction to yesterday's Federal Reserve interest rate hike, which at 75 basis points represents the largest one-day increase since the 1990s. What caught my eye as being most interesting was the response that we saw from markets where Treasury yields fell and equities rallied. Now, conventional wisdom would say you'd actually expect to see the inverse of that. Best I can surmise is that a lot of the pain had already been anticipated by the stock market, where you've been tracking it the past 2 or 3 weeks, have just been absolutely walloped, just a lot of pain. So most likely they forecasted 75 basis points is coming. There had been some chatter, it might be as high as a full 1%. So that plus comments by Fed Chairman Powell indicating that future rate hikes more or less are anticipated to be 75 basis points or lower was actually viewed as a positive by the stock market. On the other side of things, with Treasury yields falling, we saw anticipation for future rates being on the lower end of the spectrum, which makes rates today more attractive. So we saw buying of Treasuries when prices go up, yields come down. A lot of mumbo jumbo. What are the action items here? The pain initially is going to be felt first and foremost by folks that carry credit card debt. Credit card interest is calculated using short-term interest rates, which is what the Federal Reserve has most control over. Those rates are going up now. Most likely they're going to be going up next month as well. It's already super expensive to carry credit card debt. It's going to be more egregiously so in the near term. I know it's easier said than done, but if you can somehow tackle credit card balances, you really want to make an effort to do that. Second is if you have an offer accepted on a property and your lender says you can either lock in your interest rate or let it float to a date closer to your closing. It's impossible to predict where interest rates are headed. That's like predicting where the stock market's going. But just based on what the Federal Reserve is telling us that they want to do, it seems likely that rates are going up. So if you have the option to lock in, perhaps that's going to be the most prudent thing to do. Last, if you are negotiating on a property, ask your agent or ask your attorney to find out if the seller of the property has what's called an assumable mortgage. And all that means is that you are then able to assume the debt, assume the mortgage from the seller, which would make a ton of sense if they purchased the property 3 or 4 years ago when rates were substantially less. This could actually be a huge windfall for you. So something to kick the tires on. On the flip side of that, if you're considering listing your house for sale, call your lender, review your loan documents, see if your mortgage is classified as assumable. If it is, this could be potentially thousands of dollars windfall for you because that becomes very, very attractive with home rates being at, close to 5.5 if you're somewhere in the threes or fours. So a couple comments on that. If you have any questions for me, always drop them in the comments section. Happy to communicate. DMs are wide open, so certainly fire away. And always email Steven at sjlincoln.com. We'll talk again soon.